Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Friday, November 4th, 2022. It is 11:48 Eastern Time as I'm starting the video. And what I'll do is go over the equity markets. I want to take a look at the Euro-US dollar pair, gold, silver, Bitcoin, and Ethereum. So I'm going to do each of them pretty quick, just show you key levels to watch. And starting out here, we're on the QQQ daily chart. Remember, bigger picture is we put a divergent low in recently on the 60-minute daily time frame, which we're looking at here, and the weekly time frame. And those divergent lows are still intact for now, and they may certainly play out for a decent rally here. Or not, and that's why I'm doing the video. I'm leaning towards not. It's not a hard opinion, because at the end of the day, like I like to say, support is support until and unless broken. And the key support there is the recent lows, and if you take away all the other lines on here, the next biggest support level, I think, or resistance, I'm sorry, resistance overhead is about 264.38 right there. You have a lot of reactions. All, in fact, since and just before we bottomed recently, we had a trio of candles there. We rallied up to that level, failed. It was support right here. It was support back here. And so that really defines this whole trading range we've been in now since about mid-September right there. We've entered that. We've been ping-ponging around. Now, you know me, I'm recognizing these divergences. I usually love to go long positive divergences. My go-to swing trading time frame, the 60-minute chart, especially daily and weekly charts. But, you know, we are in a bear market, and as I say, those divergences quite often either don't play out at all or play out for a very small bounce before they get negated or taken out. And I'm still leaning that way. So, now, active trading, that's a whole nother story. I'm in and out sometimes 15 or more trades in a day on things like NQ when the day trading ops are there. But swing trading, I'm still short. And I added right here, this is where I think it's an objective level. If you zoom in real tight, you can see we had a reaction low here. Another candle there. It's quite a few there. There was our gap from the other day. That was Wednesday's candle, big old gap. We just backfilled. So, you know, it's a little bit below that June low right there. The June low was at 269.28, which is also resistance, but this is pretty good resistance. And the thing about it, when you have a divergent low and you had a bullish engulfing candle, there was a ton of, as I said at the time, this is on a close to a 10 on a 1 to 10 for a bullish setup. Now, that doesn't necessarily mean it's going to happen. I don't mean to sound contradictory or wishy-washy. It's like, well, Randy, why wouldn't you just load the boat long? Yeah, I told you I went long 401k monies and long-term stuff here, covering all shorts. I had a much more higher degree of confidence in that bounce than this one. Even though this was better, you did have positive divergence at that low. Remember, you had a divergent low, and even bigger divergence here. But again, it's where we're at in the cycle, the bear market. And I'm still kind of leaning towards and keeping one eye on that analog to 2008, where that's where we had a comparable divergence on the daily and weekly charts. We had a comparable rally. It was about a comparable move down, both in time and percentages, in that bear market back then, and that one just petered out. So, again, no two bear markets play out exactly the same, so that may or may not happen. Maybe we have another leg up and then the big drop, or maybe we just go on and rally. You guys know my upside targets. Potentially we could run at the 200-day moving averages in the downtrend lines on SPY and QQQ. But as of now, that's what I'm favoring, is more downside. And the important takeaway, if I'm right, I'll tell you how I think it's also going to happen. I think it'll be, and I've said this before, a very quick swoon down. And there's also, I should start, last night I really buried myself into the charts, and want to say that I'm increasingly becoming open to the possibility we could shoot right on past that fourth and final target that I've maintained all year, T4 down around 235, 236 on QQQ. And part of that is because of, and not limited to the fact, remember back in 2008, I've covered this many times, in the SPY, S&P 500, NASDAQ 100, we had comparable divergence. There was our previous bounce. It was about 10% or so there, and then the bottom fell out. But so that is certainly a possibility. But I wanted to show you one other thing too on this. Let me just go over to a monthly chart and show you what I was looking at yesterday. So this is, we'll start with the S&P 500 and then I'll show you the NASDAQ 100. One thing I like to look at, let me see, I think I marked it up on a board last night. I'm not sure. Let me just click through my various boards here. I have some fib boards right here. No, but I'm going to mark it up right now for you. I'm going to use this, show you on the S&P 500. I'm going to take a line and I'm going to show you from the peak right here to where we're at now. In fact, let's go down to the recent lows. Let's do that. Or no, if we go to now, we're looking at time. So when we look at this way, when you draw a trend line like that, this is the amount of time right here. Okay, that's a set number of periods, and that tells me that is, I can do it this way. That was about it's been a little bit over a year now, right about a year, give or take. Nope, then I did that wrong. We know that we peaked in January, so it couldn't have been a year, of course, right? We're in the 11th month of the year. We're in November. So there it is, 11 months, right? To where we're at right now. And this is a monthly chart, so these are monthly candles. So I have a, let me get rid of that one. I have a working theory, and I've talked about this before, is that we've had some big enough corrections that they were called bear markets, such as COVID when the S&P fell 36%. But those were, as I said, if you kind of weren't really tuned into this, if you're listening to my voice, you check your accounts on a daily basis, even minute by minute, you get your real-time account value because you're an active trader, and you know minute to minute, second to second, exactly what your accounts are worth. But you have the majority of people, most of the money in the stock market by retirees, people with the 401ks and the likes and IRAs, they get, in many cases, the statements are quarterly, sometimes monthly. And so when you had COVID, for example, it hit, and if you blinked, you missed it. It was over. That whole 36% drop in the S&P, 35, 36, happened in a matter of about 6 weeks, right? And then if you waited, so I'm looking at here, so when I measure this line out from the highs to the current candle, where we're at today, like that, and I put it over here, you can see from that high, if you look at where we were at that same point in time, you were a lot higher. And you can see the fourth quarter drop in 2018. So these were all corrections. They happened so fast that, again, you could have buried your head in the sand and it would have been fine. So what I'm looking at here is, again, this is a working theory. I don't have enough data points to go through this, but I do believe strongly. We know that, the stock market works every bit as much on investor psychology as it does fundamentals, right? And so when you have that last bear market, and that's what I'm going back to here, I'm looking at the peak. The peak was in October of 2007. Look at where my line goes. Here, let me zoom in so you can see it in the video. There it is. So I put the line up in the peak, and remember, you put the crosshairs, and that was in the at the end of August right there. And look what happened after that. And what it is, again, it's a working theory that it's a function of not how far down the stock market goes, but also how long it goes down for. I think you get people that start to get those quarterly statements in. And after a certain time, in this case about 11 months or so, that's where, at least in the previous bear market, the bottom fell out. And then if we go back to the dot-com bubble right here, we had about an equal high. So I'm going to use that second one because we went sideways. We technically topped right there ever so slightly in March of 2000. But again, the S&P held up and was almost at that same level at its high back in the end of the candle ending in September. And so I'm going to put that on there, and then look what happened. Look what happened at that point. Market kind of held up, had its little rallies, got rejected on one of my favorite 20-month moving average, a great trend indicator, tells you bull or bear market if you're above or below it. And after that last rejection, about the same amount of time, boom, that drop right there, from the following 2 months, the market dropped about 23%, had a counter trend rally, never got back up to that level, and then the final leg came down. So in a perfect world, I can go back, and even Black Monday in 1987, where you dropped 23 or something percent one day. Again, if you blinked, you missed it, and a lot of that was recovered because that was a one-day crash. But So, anywho, that's something to consider. That this bear market is, I still believe, in its early stages, but we may be getting to that point because of one thing that's been lacking so far, and I've said it time and time again. Nearly all of my metrics that say it's over, or at least, my working theory is we've entered a new secular bear market. And it's a very premature theory, only to be proven in time. But this was a secular bull market that we've had really since the 1970s. That was the era of, that's when you can look at the interest rates. If I compare it to edit chart properties comparison, and we look at interest rates over that period of time, TYX is the yield on the 30-year bond. That's when interest rates peaked. We ended a hyperinflationary period, and interest rates have been trending lower. Stocks go up when interest rates fall because they are the better alternative. When you can get 15% back here on a government bond, 10%, 8%, people will put their money in a safe 8%, 10% CD or bond. But when you go down to near zero, and the lower you go, it's a direct correlation. And everyone knows, if you study the financial markets, you know this to be true, that falling rates are bullish for the stock market. So we had a secular bear market in interest rates that, by all accounts, by every metric that I use, higher highs, etc., trend line breaks, ended at that final blow off bottom, if you want to call it, or capitulate in rates, where the Fed figured, we kept printing rounds of QE. And when you look at this and zoom in, here was the financial crisis, right? Back in 2008. These are interest rates. Again, I'm looking at the 30-year bond up here in blue. That was the first round of quantitative easing in 2008, where they threw a ton of money and brought rates down to near zero. And then every time the market hiccuped, you'd see the market would go up, interest rates would start going back up, and then the market would throw a little hiccup, and the Fed would come in. Right here, the market was stalling out, so the Fed threw in more rounds of quantitative easing and lowered rates. In the fourth quarter of 2018, you will recall, if you were trading, we had a huge, big drop in the markets. It was one of the biggest at the time. The Fed had just started to pivot to a hawkish stance started raising rates. The market didn't like it. It threw a hissy fit, and guess what happened? Uncle Powell and company, they came back to the rescue. I believe it was Powell at the time. Maybe it was what's her name? Previous Fed chair. Yeah, no, I think that was still Powell. And it threw a little hissy fit, and therefore, more quantitative easing. Fed did a pivot at 180, rates went lower. COVID came, and then they went all out nuclear. Again, the blue line is the rates, so that was their response. But now we've entered a new secular bear market. So therefore, it stands to reason that we probably are going to be looking at a new secular bear market, similar to what Japan experienced through the 90s and 2000s. But it'll have plenty of bull market, cyclical bull market rallies within it, and cyclical bears. And so what we're looking at here is, again, if we're at where I think we are, then we're probably getting close to the bottom. But we're also, it's going to be a quick swoon down. When I say close, more closer in time than in price. So we go back to my weekly chart of QQQ, or let me just do this. Let me queue up the NASDAQ composite for you real quick. And let's go back to that monthly time frame right here. And let's turn off the bonds. There we go. So if you look at, put up simple Fibonacci retracements right here. Here, I'll do it on this clean board I had. Put up a Fibonacci retracement level. There's the end of the last bear market in 2009 right there. We're going to go up here, and we've already retraced 38.2, which is a common fib retracement. The next level here is at 50, and then you have the 61.8 level down there. And if you look at the entire secular bull market, come back here off where we really started taking off in the early 90s, you can see we've got a 61.8 fib all the way down here that comes in at those fourth quarter 2018 drop and the COVID lows, and that's quite a ways below. And so if we get anything, where I'm going is, if we get something comparable to that big third wave down, the powerful leg down P3, if you want to call it, if you're an Elliott waiver, or the big drop we had in 2008 after very comparable price action, same thing back in the 2000, then we could slice right through my fourth target. I just want you to be aware of that and let you know that I'm increasingly becoming open to the possibility of it based on the way the fundamentals and the macros are laying out. This is also a trend line off the 2009 lows I just put up for you there, and you can see if you use the 2009 lows, major reaction low, the COVID lows right there. We're right on that trend line now, and we are clearly below that 20 months. So this says we're in a bear market, and we had that test. You can see we broke it there. There was our breakdown candle in the NASDAQ Composite. We back tested it in the month of August, right, and got rejected. And we go back to last bear market before that, and you can see you broke it here, you back tested, and then the big drop. You back tested it here for 2 months, a third month there, and then the bottom fell out. Here, you took it out, and it really never looked back. So again, the market's in a precarious position, and we'll just go back to where we're at now. Just watch those recent lows. There's still the case for a rally because you have the divergence, but remember the divergences, at least in the previous bear market, and maybe the one before that, I'd have to check, had similar divergences, gave you a little bit of a rally, and then boom, the big drop came. So just watch those lows. It's that easy. I know it's when I'm talking about these risks are, I use the term lately unilateral risk, because if these lows hold, you could have an explosive rally to the upside or a pretty strong rally. I think it'll still be a bear market rally. It'll be checked probably around the 200-day moving averages. That's usually caps bear market rallies, but that's still from where we're at today in the NASDAQ Composite here about almost 18% or so. And do you want to be short throughout an 18% rally? It'll also come in around this downtrend line. I don't know if you can see my 200-day moving averages. They're here in blue and red. I have the lines kind of turned down, but they all come in together. The 200-day simple, exponential, and the downtrend line. So that's the bull case. Again, it's simple. If we take out those recent highs right there, we're probably going to get it. Otherwise, we undercut the lows, especially if we take out the divergences. We're probably going lower, but again, we're probably going lower in a very fast, impulsive fashion. So just be ready to either flip sides, if you're long or short, and the evidence starts to mount that we're going to go higher or we're going to go lower. And if you don't know what to do, you can always jump in. If we break down for lows, we're going quite a bit lower, in my opinion, at minimum to my next targets. Usually I'm using QQQ, this NASDAQ Composite. You've got about another 7-8% minimum. Okay, quick update on SPY, the S&P 500. You had this uptrend line here we recently broke. It's been all over the place. You had a little downtrend line there, but when you zoom down, remember on the 60-minute chart, we just broke down from that bearish rising wedge this week. We're rallying to big resistance, about 390 level right there on SPY on the 60-minute chart with negative divergence, bearish rising wedge, breakdown, and we're stair-stepping lower. We've certainly met the measured target for that wedge, and so maybe that's it. And the S&P is still comfortably above its lows, so you got to give it that. The NASDAQ has been a weaker index lately, and that's because the FAAMGs were a crowded trade. They were over-owned and over-loved, and so you have just a lot of, the mutual fund redemptions. They're selling what their top weightings are, and that's Apple, Amazon, Facebook, or Meta, and the likes. But remember, in a downtrend or in a bear market, it's usually these small wedges are the catalyst for the move down to new lows. Just like in a bull market, you look for these little 60-minute wedges and pullbacks to support and other bullish chart patterns, and the breakouts of those usually far exceed the measured target of the wedge. They usually take you to new highs in a bull market. But in a bear market, you can see we've been stair-stepping lower, and a lot of those, the counter trend rallies end with these wedge patterns and divergent highs, and then you get the next leg down, you get some divergence, you get a little rally, you get another wedge, divergent high, and you break down, and that's what's been happening here. And so this is the most recent breakdown. There's our primary uptrend line, which again would be a target if we do hold the recent lows. Like I said, the SPY is comfortably above those lows. The one thing I will almost guarantee you is you're not going to know today. Today's Friday. There's only 4 hours left in the trading day, and the SPY is comfortably above its previous lows. It would take a heck of a drop today to get us down below there, so that's probably not going to happen. Nor could we go up enough today to do anything bullish. At minimum, we'd need to take out that 390 level in the top of that wedge. And then even more powerful would be a break of this downtrend line. So they're going to keep you guessing. And what I usually do with that is just lighten up before the weekend. We're either going to gap up or down on Monday. If you trade futures, they pick up on Sunday night, and you can maybe get back in there. If you want to be short or long. Let me show you a couple other things. Let's look at the euro's been all over the place. Euro and gold. Gold's looking good, but the euro, recently I pointed out, this is a 60-minute chart. You had the downtrend line, this triangle pattern. We got an upside break. We rallied up, hit my 1.00340. Nice resistance level. Overshot that a little. Got close to the next target. Then we've drifted back, but what's happened is we've now we back tested. When I take that triangle line, which I did, and I extend it, we made a perfect back test. So that's a breakout and a back test. So far, a pretty impulsive rally. Got knocked down when the Fed raised rates, but you have a lot of the ECB is starting to finally play a game of catch up. The Bank of England recently hiked 3/4 points, so they're trying to catch up with the Fed now. Before they were lagging, and so you might that might be the fundamental catalyst to see the dollar start to move lower now. And there was the uptrend line as well in the triangle, so pretty much back test to both, and we moved up. And you look at the daily chart, and you have the secondary downtrend line right there. We had a breakout pre-Fed, but that's why it didn't go very far. Also ran into resistance. And now we've pulled back to this trend line. So if we can rally up here and take out that 1.00893 level, which I think is a good chance we can rally up to there, that's going to be net bullish for gold in the dollar-sensitive assets. So I'll get to gold in 1 second. And the reason I think it's likely to happen is we just put in a big divergent low right there. And still plenty of work to be done on the euro, especially a big resistance zone up here. But there's your downtrend line on the weekly chart. So this is the first downtrend line. If we can break that, especially on a weekly closing basis, this is why you don't jump the gun if you're trading a weekly time frame. You had an intra-week break recently, but that big the big Fed meeting, all that knocked it down. We're back right on the trend line. So if we can clear this and get a solid weekly close, that should open the door for a run back up here to the resistance zone and this larger or a primary downtrend line right there. And that would be a nice move in gold. That would be a fundamental catalyst or bullish for gold. And speaking of gold, I'm going to start out with gold futures for you. This is a 6-month chart, very constructive chart. You have a downtrend line. This is your primary downtrend line, but more importantly, you have this triple bottom right here, or 3 almost equal lows. In fact, each one was slightly lower than the other, and what that did, it's given us divergence. It's been building. We had divergence at that first low right there. That was a divergent low, and it's not as if it didn't pan out. We had a nice rally, nice tradable rally, ran into resistance. Then you came back down, it made a slightly lower low, but we extended the divergence. And gold rallied again, not as much that time, but it's come in, recently undercut that low ever so slightly, and that's about 1620 here on gold futures, and the divergence is even larger now. And we just took out this downtrend line, and this here, I'll zoom in for you so you can see it better. That's not working. Let's do this and take it in tighter. I messed things up for you here. We'll go down to a 3-month chart. There it is. So there's your downtrend line right here in gold futures. We're at resistance right here, 1677-ish right there. But we've broken out. There's the those 3 lows right there, 3 slightly lower lows with the positive divergence here on the 60-minute time frame breakout. So we need to pretty much take out today's highs, and that should take us up to my next target, about 1697, then somewhere around that 1730 level if that happens. And so again, if this happening is largely but not exclusively conditional to the euro rallying and the dollar falling. is my preferred scenario. So, and look, the thing is, this is why you should always have your stops a little bit below the actual support level, because each of these little lows are little stop raids. They take it down a little lower, they clear some stops on long, suck in some shorts. So at this point in time, you should have a stop over there, under there somewhere, or you could even have a stop if that downtrend line breakout fails. A little stop there. You can see all the support levels, and it all depends on what you're targeting. So that's it. I still remain. I'm still leaning short equities. And long gold and silver, the precious metals, they're offsetting. Well, today actually the market turned red since I started, so now everything's actually doing good. What else did I want to show you? I already covered the currencies. No change in bonds really. They're about where they were yesterday. And oh, the cryptos. Yep, cryptos. Still looking constructive, but remember, they trade very much in line with the stock market, or at least have all year. If I look at a 6-month chart of Bitcoin futures, and I just updated these the other day, we did have a pop above that downtrend line in the futures today, and we're still above it, but not by a large margin. You have price resistance. That level is 2682. We're roughly on it, just a hair above it, but not close enough to say it's a solid breakout yet. And there is a little bit of divergence. There is divergence. It's unconfirmed, but some negative divergence. So what's going to happen if the stock market breaks down? This may break down. There's a trend line. If the stock market can rally, or maybe crypto finally retains its claim that it's an alternative to the stock market and to other assets, and you could start to all of a sudden see crypto rally even if the stock market falls. That's not been the case lately, but again, you have the levels to watch there. If we can take out these divergences and really just build on this breakout today, then your target's 22,382. Probably get some resistance. I'll give you one more level there, but again, don't get married to it. And like I said, you have a trend line here that if it takes out that uptrend line, it's probably going to go lower. There's some support down below. I could certainly mark that. Let me give you one line. And Ethereum's going to trade, give or take, with Bitcoin. These are the two big ones, obviously. There's support level 1, other than the trend line, and support level 2. That's about 19. What is that? 19,858, and then 18,816 right there. And then under that, it starts to get real thin, and then you have the previous low there. All right, I'm going to wrap it up here. Anything big happens, I'll do a end of day video. But again, I don't think the market's going to show us its hand. The Fed is out of the way, but we're kind of bouncing between support and resistance. So it's still anybody's game. But as of now, I'm still favoring the downside. Plan to go home short over the weekend. May end up regretting that, but hopefully if the markets gap up big, I trade the future. So if they're up big Sunday night, I can still mitigate, stop out then if I want to. But also we're seeing, a lot of these risk-off assets, gold, silver, starting to rally, starting to look constructive. And, I'm still long some treasury bonds. And so they will usually rally, or we've started to see that return to the old risk-off, risk-on, as I talked about. And so, but if the direct correlation continues that we've had all year, then as the stock market goes up, treasury bonds and then may rally and offset that, being long treasuries. So again, it's what I call an indirect hedge. In a perfect world, that relationship will start to strip away. I've seen early signs of that, not enough to say it's we've returned to the inverse correlation, but if we do, then that's all the better. If I can make profit on short equity portion of my portfolio and long treasury bonds. And like I said, I flip around. Monday, I'll maybe singing a different song and telling you I closed out those shorts, or I plan to close them out and then go long, depending on what the market does. Like I said, it's really, really fighting hard to hold these recent lows. And so far, it's done so. That's it. You just can't write it off as long as the S&P 500, NASDAQ 100, and Russell 2000, all the indexes are still below their previous lows with positive divergence still in place on the daily and weekly charts. But one of the reasons I've been, back to the bearish, positioning, short positioning. I'm looking at a lot of components. Apple didn't make a new low, but those that did, Microsoft, for example, what I'm showing you here, I can see these divergences finally getting burned through. Microsoft no longer has PPO divergence because it's made a lower low. On the weekly chart, Alphabet, same thing. It's gone. It's burned through that divergence there. And so this is what I think the market may end up doing, especially now that the market leaders are doing that. Amazon still has its divergence, so I'll give it that. That's why it's not an all-in moment. You just take this line, you still have lower lows, and it's what I call potential divergence. But as I said last week after they reported, they took out this 103.31 that was key support, and we're below it, and we're in no man's land. Now we're 2/3 of the way down to my next target, and I said once you take that support, and we're going to close a week. This will be the first weekly close below it now, this candle here, right? And so that increases the odds that we're going to hit that next target there at 83.35. And if we do, we may still have divergence. We'll see. That's where I told you last week that Amazon will look interesting as long as the rest of the market looks like it's a buy as well. I wouldn't buy Amazon if I thought the NASDAQ 100 was going to go much lower, because it would drag Amazon down with it. All right, let me wrap it up here, and I'll get the video out to you guys. And if anything changes before or by the end of the day, I'll let you know. If not, we'll pick it up on Monday. This has been Randy Finney with Right Side of the Chart. Have a great weekend.